Okay, let's settle one of the biggest debates out there. Should you buy a house, or should you be investing that money in the stock market? We're going to break down which path actually builds more wealth over time and which one just feels safer. Let's get into it. So to figure this out, we're going to follow the story of two people. They are identical in every way. Same job, same salary, same savings, starting at age 23. But they make one single different choice. Person A, we'll call the buyer, decides to save up for a down payment. Person B, the investor, decides to rent and just invest the difference.
We're going to follow these two, the buyer and the investor, on a 20-year journey. We'll see them go from their early 20s all the way past age 40 to see how this one decision completely shapes their financial lives.
So at the starting line, everything is exactly the same. They're both 23, both starting with $11,200 in the bank. Now, the buyer, they diligently put $800 a month into a savings account they call their house fund. The investor takes that exact same $800 and splits it. $500 goes into a Roth IRA, and $300 goes into a regular brokerage account. You see? Same money, just headed to different places. And then, bam, 3 years later, at age 26, the buyer makes a huge move. They take $70,000 in cash and buy their first home. Now, that's almost $60,000 for the down payment and over $10,000 in closing costs. In one single transaction, their entire house fund is gone, transformed into a physical asset. So right here in these early years, that single decision to buy a house immediately starts to push them down two totally different financial roads. And here's where we see the first major split. By the time they're 29, just 3 years after that home purchase, the investor is already ahead by over $62,000 in net worth. I mean, sure, the buyer is building equity, but the investor's portfolio? It's being fueled by consistent contributions and market growth, and it's just compounding way, way faster. But here's the thing, net worth isn't the whole story, not even close. They're building fundamentally different kinds of wealth. The buyer's wealth is all tied up in their house. It's illiquid, you can't access it easily, but it gives them this incredible sense of stability. The investor's wealth, on the other hand, is liquid, it's spread across thousands of companies around the world, and it offers incredible flexibility. All right, now we're entering the mid-game, and this is where that magical engine of compounding really starts to kick into high gear for our investor, and you're gonna see the gap between them just get wider and wider. By age 35, the difference is just staggering. The investor's net worth has exploded to over $500,000. They are now leading the buyer by more than $240,000. The buyer's home value has gone up for sure, but it just can't keep up with a diversified portfolio that is firing on all cylinders. And to really put that power into perspective, get this. In a single year, the investor's portfolio grows by over $36,000 just from market returns. They didn't add a single new penny. Their money is now making more money on its own than a lot of people save in an entire year. That's the magic of compounding, right there.
But hold on, let's not count the buyer out just yet. They have a powerful, hidden advantage that you won't see on a net worth chart. Their single biggest monthly expense, their housing payment, has been locked in, fixed since they were 26 years old. So while rents are going up and up and up every year, their payment is this predictable anchor, and it's an incredible shield against inflation.
So this brings us to what I like to call the hidden rules of the game. Because the real-world outcome, well, it isn't just about appreciation versus market returns. It's about these hidden costs and human behaviors that most people totally ignore. Okay, one of the biggest ones you have to know is the 5% rule. It's basically a simple framework that says every single year, a homeowner is going to face unrecoverable costs, that's money you spend that you will never get back, it doesn't build equity, equal to about 5% of their home's value. It's the financial drag that's not on the mortgage statement. So where does that 5% come from? Well, you've got about 1% for property taxes, another 1% for general maintenance and repairs, the roof leaks, the water heater breaks, and then 3% for the cost of capital. That's either the mortgage interest you're paying or the returns you could have earned if your down payment was invested instead. For a renter, this whole unrecoverable cost is just their rent. Now, for the human side of things, the behavioral equation. Homeownership, it's basically a forced savings system. Every single time you make that mortgage payment, you're automatically building a little bit of wealth. The investor's path, though, that requires a ton of discipline. You have to actively choose to invest that money month after month without giving in to the temptation to just spend it. And there's another huge opportunity cost that almost nobody talks about, the career anchor. In your 20s, being able to move is a superpower. Renting gives you the freedom to chase those high-paying jobs in booming cities. Buying a home can literally anchor your career to one spot, and the lost salary you could have earned by moving can easily be more than the equity you build in those early years.
All right, time for the big reveal. Let's fast forward to age 40 and check out the long-term scoreboard to see how these two very different life choices have finally played out. And at age 40, the numbers are, well, they're pretty clear. The investor is officially a millionaire, with a net worth of over $1 million, nearly double the net worth of the buyer. I mean, on paper, this looks like a total blowout.
So, case closed, right? The investor wins, hands down. Well, not so fast. The real story is way more nuanced than just one number on a chart. Because check this out. By age 40, their monthly housing costs are almost identical. But here's the catch. The buyer's cost is locked in. It's actually getting cheaper every single year in real terms because of inflation. The investor? They are completely at the mercy of the rental market, facing unpredictable and always rising costs. The tables have totally turned. And if we project this all the way out to age 58, yeah, both of them become multimillionaires. The investor still has a much higher net worth, sure, but the buyer, they will own their home free and clear. Their cost of shelter will drop to practically zero, giving them a level of financial security and predictability in retirement that the investor will just never have. So you see, this isn't really about which path is right or wrong. It's about choosing the system that's right for you. So how do you actually decide? Well, the choice really comes down to your personality and your goals. First, you have to be really honest with yourself about your own discipline and your career path. If you know you need a forced savings plan or you plan to stay put for a long time, buying can be great. But if your career demands mobility, renting is a massive advantage. And second, align your choice with the lifestyle you actually want. One path offers stability and control, the other offers flexibility and freedom. You know, when you boil it all down, both are just systems for building wealth. One system stores it in walls and a fixed address, the other stores it in markets and mobility. Both systems do what systems do. They both compound. The only real question left is, which system are you going to choose for your life?